taking place. So I hope we're going to get quite a few interesting insights from that. We have Erick, which was the CEO of Hisa Capital before he had his M&A of the Nigerian fintech. Sonia from BuuPass, who has been undertaking several M&As now, which will be interesting to learn about, on one company in South Africa. Adam, who is CEO of a company I thought was a Swahili name until he told me it's a village in Ireland called Antrim, Mashariki.
Antrim, Mashariki.
And then we have Justus, which is a CEO here at TRIFIC. I guess we're almost at his office. If you find E13, that's where you'll find Antler. So thanks so much, everyone, for being here. And maybe to get us going, would you mind sharing a little bit your background and your exposure to M&A? Maybe the company you're at, a little bit what experiences do you have in the field? And maybe start with the entrepreneurs. I know, Sonia, do you want to go first?
Sure. Hi, I'm Sonia Kabra, co-founder and director at BuuPass. And what BuuPass does is we have a platform where you can book your bus, train, and flight tickets, and we also have solutions for transport companies to digitize their back office. And we never thought that we would do M&A at an early stage, so we are kind of 6-7 years old right now. But last year we had a very interesting opportunity to acquire a competitor in South Africa called QuickBus. And I think when we got it, we first thought maybe it's too early for us to do it, but given where the capital markets were, how fundraising had dried out, I think it became like an affordable acquisition for us. And that was our first exposure to M&A, and we learned quite a lot through the integration as well. And right now we are in the phase where we are looking at M&A as one of the ways to grow across Africa. Yeah.
And seeing the players take each other down, score goals, get injured, get rid of the pitch and all that. But what I have witnessed so far, and this is probably a takeaway from this Age of Fair Africa event, is that anyone has a price. I think there's no one who cannot be bought, because I have seen guys I had a lot of respect for, thinking this is a big boy in the field, and then they get acquired just like this, and before you know it, they become part and parcel of a bigger entity. And so what I have seen as I interact with entrepreneurs and investors here is that literally everyone is looking for an entity they can acquire, and at the same time looking for an entity that can acquire them. The big boys are looking for the small boys, and the small boys are looking for the big boys. But within that arithmetic is the whole question of whether you emerge stronger or weaker after the acquisition. And then secondly, whether you have a plan post-acquisition. Do you just die off and then go and rot? Or do you bounce back and sort of go and start all over again and look for another suitor to acquire you? Or do you use the proceeds to go into another completely different line of business? But the other thing I have also seen is a situation where some guys, out of the allure of a very good deal, rush into an acquisition. And then post-acquisition, what they thought was a good opportunity for them to become part of a bigger agenda or a bigger business. Then they die off. They have no voice in the business. They lose their equity stake. Somehow along the way, they get diluted. You started off with a 30% promise, then before you know it, you're at 3%. And then before you know it, board meetings are happening and you know they happened. So it's good to position yourself in a way that you plan yourself because it's your business. Otherwise, everyone is looking to exterminate the other. This has not happened here, but I've also seen this before, where somebody considers you a bad threat. I don't know that you have going to take meat, and then there's this fly that keeps nagging you. It's not eating the meat, but it's preventing you from enjoying the meat. So somehow you're tempted to just kill it off so you can enjoy your meat in peace. So there are the big boys who will see you as this nagging fly, then they acquire you, then they kill you so that they continue to enjoy it. So I think these are the things, as a spectator, I keep seeing. And I dare put it out here that we need to be a little bit careful so that this, again, does not kill our dream and swallow us out. Thank you.
Sonia, I don't know if you saw QuickBooks as a fly or not, but why did you decide to undertake that acquisition? As a relatively young company as well, you could also have built yourself. What was the rationale and thought process that went into doing that?
So when we got the opportunity, expanding into South Africa was in our roadmap. It wasn't as immediate, but it was in the next few couple of years as well. And then we got an M&A advisor. Thankfully, it was an advisor from one of our investors as well. So one of our investors, Founders Factory, is called 54 Collective now, and an M&A advisor helped us negotiate the deal. So the price that was being quoted initially was so different from how the deal was done. So as you said, everybody has a price. So I think that was kind of one of the first lessons we learned. And once we started doing the analysis of building versus buying, we saw value in the relationships that they had built in South Africa. So at BuuPass, we have a component of the business where we need to distribute our services to the customer who can buy tickets. And they already have contracts with banks and telcos and the top bus companies in South Africa, something that could have taken us years to build. So I think the time component as well as the price of the acquisition and then buying into the dream, because we also gave them some shares, worked out for us. Yeah.
And landing on what's a fair value, what was that like? How did you go about that? Because I'm sure there's a little bit of pulling back and forth going on. So what was that like in real life so people can experience what you experienced a little bit?
Yeah, it was a huge lesson in especially at a smaller scale. It's a very personal decision as well for the founder. So getting to know the founder, understanding what's important for them, and then kind of structuring it that way helped us. So I think also having some sort of an advisor helped you negotiate that. Helped us as well. So there was quite some back and forth that we were able to land to a agreeable price. Yeah.
Okay. And Erick, on your end, your company got acquired. So what initiated that acquisition of Hisa by Rice, a Nigerian fintech? And when did you know it was the right time to sell your company?
Interesting. I'll jump back to what Justus was saying. there are two ways you answer this. There's the answer you give the media, and there's an answer that you give the investors and founders. They know the truth that is how things happen. So maybe I'll start with the first one. Number one, the business model. I think initially, when I ran that business and I met a couple of investors who were facing in the room, everyone wanted to give me money. Everyone wants to give you money. But I looked back, is that business model scalable? And then the other bit of it was, to be honest, which is, maybe the media will tell them, but I get on the back end, the story is, was the business model making sense? Can you scale? Like I saw myself, was I going to continue doing this for the next 5 years? And to be honest, it's because they built enough structure, so proper structure, initially to help me scale this. So I think the first thing that I needed to is fix out the model properly. And if I couldn't change it, find a better way to do it, which is build the business afresh. the beauty is that I've supported kind of investors that I was working with. So when I started the discussions around, because the business model wasn't making sense, we were, funding me to number one. I couldn't be able to raise more money to continue. The beauty is that investors who are like, sell it, we get out, we get our money, whatever. Pay the liabilities, which is what I wanted, because I wanted to change the business model. I'm a financial markets guy, so I saw number one, the execution bit of that business. I looked at it this way: do stockbrokers locally make money? Maybe. Do stockbrokers locally make money? Yeah? You think so?
Maybe a little bit. If they're good.
Have you seen a stockbroker or an investment bank that have scaled significantly across the continent? Right? So I look at it that way. But could you build a financial media software company for the continent and sell it globally?
Possible.
Easily, very possible, right? Yeah. So my goal was, do I kill the entire thing or sell it and start afresh with a proper team and build it from the structure? So that's why I decided to make the decision. I want to build out the entire thing afresh with a proper team, and build it globally. But I couldn't kill that company, I had to sell it. So I had a conversation with my investors, and because initially what we had a holding company that owned the media and the fintech. So one of the things I negotiated for is they leave the media business, like it's going to be part of my new entity, but they acquire the fintech. So but the beauty is that that's the discussion. Then they'll have to take off that, pay off investors for a period of time. But then from just in terms of, I also wanted to make sure we are aligned from investors on that side. Yeah, but it took a bit of a while, like 1 year to talk to potential investors. But the beauty is that already had some of this initial relationship with potential acquirers. So by the time of an acquisition, I think it was already a decision to make.
How did you find the acquirer? Was it a very proactive process? Did you find multiple potential buyers and you sort of had a process with them, or how did you from the moment you knew you wanted to sell? How was that an organic process, or was it led by yourself, by someone else? How did all of that play out?
So initially, when we made a decision we want to sell, I think the first people we informed were our investors. We want to sell. We are happy to sell, and we already have potential acquirers. So I think we have 3 potential acquirers. One is a South African listed company that does something similar, and 2 Nigerian fintechs. I think we had the first discussion with the South African company. For them, their decision, they were very keen because what they saw, the value was the regulatory approvals that we had. They were like, you guys have regulatory approvals. We spent 5 years getting top law firms locally to help us get licenses, and they have been able to do that. So but the problem was given that they're a listed company, getting shareholder approval for approval. There's a process to that. Secondly, we were speaking to West African companies. One, I think we got to the stages of closing, but their board were like, the valuation doesn't make sense for us. Then the third one was a bit easier decision to make because the founders were learning that they were interested in coming to this market. So there was a bit of a relationship in between. And then thirdly, it's a very small market. So ideally, if you work with, say, New York-based broker dealers, the same people that we push our orders, market orders to them are the same people that Kabra is indexes. So it makes sense for a consolidation to happen so that they have more orders.
Great, thanks. So I remember I also sold my business, which was interesting. I remember it was in Ethiopia, it was a paper company, but it's already going to go the wrong way when the first thing the acquirer does is to look at your balance sheet and say, so let's say how much assets you have and do a multiple on assets. It's not even multiple on the beta, which a lot of PE firms, which venture firms, again, thinks is conservative, right? So it was the most conservative starting point I've ever seen. So, Adam, in the shoes of a CFO, how should founders think about valuing their business, and how do you find a price that both buyer and seller ideally will feel happy with? Like, what are the tools and things you would, how would you go about that?
No, thanks so much. And I think what Justus said about the flies, right? The key question, and also for you strategically, they're buying your licenses, right? So I think on both sides of the coin, what is it worth to the most strategic acquirer? And I think that's the way to get the highest valuation, right? If you looked at it from a pure balance sheet perspective or from an income statement, cash flow, you probably would not get the type of valuation that you would get in this case. So there are a bunch of different valuation methodologies. I think the starting point for the founders is the discounted cash flow. And from there, very mathematically, you can show what the value of a company is and prove it out, given all the different assumptions, discount rates, cash flow, revenue, etc. So I think that's the starting point. Then you look at the different comparables in the market and the multiples on revenue, EBITDA, or whatever. So I think it's really more of an art than it is a science.
And if there's not enough cash on the table, like what other structures could there potentially be where you can still get your money out, but maybe in a different modality?
For sure, so shares, right? You offer shares to the company that you acquired. I think there's also ways to do an earn-out or add royalties so that the acquiring company can get royalties on the acquirer so that they get money and cash out over time. Especially if they have an operational role in that company, you want to make sure that they're incentivized. And so you would ideally do it as a royalty, a bonus, salaries, or a time-bound mechanism that allows them to cash out after a certain number of months or years. So for the example of the acquisition that I was part of on the financial side, it takes a long time to transfer over your tech resources and also your financial systems. So if some key person in the middle of that decided to leave because they weren't incentivized, it would cost the acquirer 5x, 10x. So I remember at the end of this, for my acquisition role, they gave me a nice bonus that I used to partly buy the cows that I had, so.
And Justus, what are the opportunities and threats you think startup founders should be very mindful of before walking into an M&A process? What are the things that you have seen as the observer?
Well, I think from picking from the conversations ensuing from the panelists and from other conversation, I think from the onset, a merger and acquisition is an opportunity for growth. And I think this needs not be emphasized, other than to say that the process of growth is a question of time. It's a question of how much time you think you have on your hands for your business to grow to the levels you want. And when you merge, when you get acquired or you acquire, it's sort of taking a jump in a bid to move from one level to another level that would have taken you otherwise a longer time to get there. Your balance sheet becomes better, your P&L gets to look better. And one of the entities that got acquired from within our ecosystem, we had a tea conversation with them, and I was like, dude, I thought you were doing well, what happened? He told me something very profound. He told me, I would rather have 1% of a multi-billion business than have 100% of a 3 million shilling entity. And then I'm bragging around that I'm the founder and CEO, and there's nothing to it. And then he was showing me the numbers of what it meant to be part and parcel of the bigger entity. He told me, yes, I have less headache. The big boy is now working for me. And I have, at the end of the day, I think anytime you want to understand where your business would fall, how your business would look like from an SZ environment, it may not be enough to speak all of it here. But from a snapshot, that is it. But you're welcome to come and sit with us and we have a conversation. Brian Mwao is here, who is our business development manager. We don't just sell rental space. We discuss your business with you. We help you to structure. And maybe, Brian, for the people who are here and listening to me, we can consider rebates and sort of an incentive framework for your offices if you want to discuss moving your business into the TRIFIC special economic zone. And we can have that conversation so that also you are coming here as also other added benefits. So you don't pay the same rent like other people would be who did not come here.
Sounds good and worth discussing for those interested. A couple of more questions, and then I'll open up the panel to questions from you guys. I guess, Sonia, I wanted to know, because once an acquisition has taken place, there's a lot of work. It's easy to think sort of when the deal has happened, it's done, but it's not, right? So what was that post-merger experience like? And also, how did you make sure there were no hidden sort of bodies in the closet that you could, eventually discover as part of that post-merger work?
Yeah, that's a great question. So even before we, gave a complete green light to the acquisition, we made sure that we really sat down with the people, the stakeholders that are a part of it. So this included the team members of QuickBus, their investors, their clients. We were keen on two of their entities, South Africa and Nigeria. So both my co-founder Wycliffe and I, we went to South Africa, spent time there, understood the business model and tried to, get to know the team members too, because a huge part of integration, apart from tech, is also people integration as well. Similarly in Nigeria too, and in Nigeria we realized that their business model there might not work for us, but the contracts there are still interesting. So we then structured the acquisition in that way. Once the acquisition happened, then honestly I would say the tech part was the easier part, because we had similar technologies, we streamlined it, we retained. I think the difficult part was to understand who to retain and who to let go, because one of the value propositions for us was to streamline the costs and hit profitability much faster. But because we are a primarily Kenyan East African business, acquiring a South African business who even have team members in India and Nigeria, there was a difference in the ways of working, both like the local cultures as well as company cultures too. So that's something that we are still working on, where we are trying to create this unified culture for BuuPass that is in our different markets, and also see how we can use the staff members that we have retained at a group level. And when we acquired QuickBus, it had reached good growth. Their South African entity had reached break-even, but they were not growing at the scale that BuuPass was growing. So that's one of the other I think challenges we had as well, where I think as a founder, I now split my time between Kenya and South Africa, where I work with the teams there to unlock more growth, work with their partners as well. So it's still an ongoing process. I think one of the key lessons was people integration is much more challenging than tech integration. Yeah.
And Erick, for you, was there any post-merger, post-acquisition work, or it was quite simple? Once the deal was done, you could walk away. Like, what were the things that happened after the process for you?
Actually, a lot of work is in the post-acquisition. So imagine informing your regulators. Then the tech integration, I don't think it's much, but them trying to change. Because when you buy a business, you want to fix and make it scale significantly. So there's a lot of work that will go into into doing the strategy for that. But my role was purely being like an advisor. I made that clear because I had little time to run the business. I'm more focused on this meeting. But I made it clear that look, I'm only going to get a strategic advisor. I'll still get the benefits of taking a stake, cash, whatever. But I'll only apply on the advisory. But again, helping them, build a team, I still do that. Maybe helping them hire new CEO, I still do that for them. The team that they need to fix. But a lot of work, because I'm still involved in helping them. There's a lot of work that's involved in post-acquisition.
Great, thank you so much, everyone. I wrote down my 5 key takeaways, and then I'll open up the floor. So stuff that I've learned from you guys, and thank you so much for sharing. Is 1, everything has a price, and you hope you're not the fly. There's strategic value sometimes in the business that can matter more than some of the business, the pure cash flow of it. For example, like licenses, partnerships, and other stuff that can really save time versus just the money in it. Cash and other structures can also be a smart way to structure it. If there's not enough cash on table, people can be happy through royalties or other arrangement shares, etc., to get all stakeholders together. Post-merger work should not be underestimated. There can be a lot of long tail work following a deal, and make sure you base yourself in the special economic zone, because there are a lot of benefits associated with that. So any questions from the audience? Anything we haven't touched upon that you guys want to ask? I don't know, there's a mic going around.
Yeah, maybe your thoughts. We've also been involved, not in a full acquisition, but partial exit to a big corporate investor in South Africa. What's your thoughts around corporate acquisition? So not necessarily, where it's a partial exit, where you are in a similar business where there are clear synergies, but what we sometimes see is a big corporate acquires your business and they think they can do it better than you, but actually they just couldn't, and it looks really bad because the culture is wrong, especially with tech and highly innovative business. They require a different approach and a different culture to really keep growing there.
Do you want to have more questions, or you want to answer this first?
Yes, I was curious who wanted to ask the question. I guess around corporate acquisitions, right? Anyone? No one?
I think it's just the culture, right? And so the one that I referenced, the particular acquisition, it was really around big bureaucratic systems for a smaller tech company. And so integrating the people. And some people said, it's not for me. I'm not into this bureaucratic meetings, Teams calls, blah, blah, blah. I wanted to build tech. And that's what they did before. And they just said, I'll do something else.
But I also think it would depend on why you're going into a merger, why you want to be acquired. So that then in the end, that objective informs your expectations, so that you don't get disappointed in the beginning or at the end. If, for example, you're going into a merger or into an acquisition just to make your money, and your money has gone into your pocket, why would you get disappointed when they do with your company if you got the money in the beginning? Because that's the money you wanted. But then if you wanted to enter into this arrangement for growth, then you need to structure the mechanisms for growth and your involvement and your contribution, so that then the parameters, the mechanics around it are defined from the beginning to preempt a situation where then along the way you start feeling like the vehicle is going south, then south. So I think you need to be very clear at the structuring stage where you want to go and your contribution to where you want to go.
One question. Oh, there, first story.
Hello, Chimbo Tanya Advisors. So I had a question about the special economic zones. Do you coordinate with other zones as well to help facilitate, let's say it's a multinational company? Then if I may, I have a part B too. So for SEZs, is it more beneficial for maybe a service-based company than a product-based company, or either it's really the same benefits?
Yes, I think so. In the answer to the first question, yes, we do coordinate with one another. In as much as sometimes you cannot avoid looking at each other as competitors, because you're looking at the same market. But there's a level at which we cannot afford to look at each other as competitors, especially when it comes to advocacy for better incentives, advocacy for better regulatory environment, advocacy for better administration of the zones. At that point, we really align, and we actually have an association of special economic zones in Kenya, which is still at its infanthood, but we're trying to strengthen it. Then our platform for engagement is not 100% whimsical, but it's sort of defined through a platform where we can all meet and on a day-to-day basis define what is affecting us. But then secondly, the question you asked about services versus other types of commodities, goods and all that, the framework is the same, the law is the same, but at the operational stage, there's a bit of divergence. The reason we went for the services sector, because we are a simple sector special economic zone focused on business services, is because one, business services are the focal point of economic growth in Kenya. As we speak, business services account for about 59% of the country's GDP, and also account for 51% of jobs creation in the country. But for you as an investor, and we don't shy away from saying this, we sort of took advantage of the fact that the East African Community Customs Management Act of 2014 is basically about goods. And so you would have no advantage if you manufacture your goods and you're selling them to Uganda, to Tanzania, to Rwanda, to Burundi, to the rest of the East African community. Because at the point of crossing the borders, they are not construed as exports and all that. You can't enjoy any incentives. So if you produce goods and you just focused on the EAC market, then this is not for you. At that point, you suffer some disadvantage. But for services, it will be an export if you are selling these services to Uganda or to Tanzania or to any other country, because the taxation framework is basically the domestic taxes. So if you come to Kenya, you realize the VAT in Kenya, for example, is 16%. You go to Uganda, I think it's 18%. You go to Tanzania and Rwanda, it's staggered. It depends on what it is you're selling. And so, for that particular purpose, it becomes easier for people in the services sector to benefit more when they domicile within a Kenyan SEZ, because then the EAC market is an export market for you. And the incentives available for exported services, exported goods will apply to you, and they will not apply to another person selling commodities. So that's probably the major divergence between the trade in goods and trade in services within a special economic zone.
Great, one more question.
Hi, Sonia. My question is for you. When you did your acquisition in South Africa, from a legal and regulatory point, did you have any major challenges that you could possibly share for people who might be interested in such cross-border acquisitions when you're in the same industry, but you might have different regulatory frameworks? And then also post-acquisition, what structure did you end up with the company? Is it like a fully owned subsidiary for your Kenyan business, or you had to set up a separate entity, possibly with the same directors? How did that pan out?
Yeah. So legal costs definitely, especially as like an early stage company, can be high when you're doing an acquisition. So definitely for us, having support from our investors as well as getting an M&A advisor helped us structure it well so that we knew what to work on. BuuPass, our holding company is in Delaware, so which owns 100% of the subsidiaries. So we followed the same structure for South Africa, and in the process, we also actually bought the entity in Nigeria as well. Part of the acquisition was to make sure that we buy all the assets, the IP, what was important, the contracts, as well as making sure, the contracts that they had, let's say with a bank, because now that there's a change in ownership, all of that was signed as well. And so both the shares and the cash were paid based on hitting those important milestones. And interestingly, when we announced this acquisition, we saw a lot of smaller players approach us as well in different markets in Africa. So now we're also looking at if we already have an entity in a specific country like Uganda or South Africa, we are using those entities to sometimes do an asset buyout instead of doing like a complete company acquisition as a way for us to increase our market share.
I think we're good on the questions. One more.
Sorry.
Final
Yes.
quick one.
So I do part A's and part B's. I think part A will be to you, Eric, and part B will be to you, Adam. So Eric, leading up to the acquisition, is there anything you did strategically to increase your valuation multiple? So that's something. And then for you, Adam, are there things, because there's different multiples once you get larger, you can raise your multiple. But let's say companies start us before Series B. Are there things they can do to increase their valuation or to lower their valuation if you're on the other side in terms of negotiation?
Is there anything that we did? Maybe what I could remember we did was guaranteeing the buyer that, look, you're going to the contracts that we had. For example, a good example is we had a lot of fund managers in local sort of institutions who needed global access to securities, for example. We had signed some of this, but that was based out of my relationships, right? So one of the guarantees I gave them, because these guys move significant volumes of cash for money, post the acquisition, in as much as we had not set up the big piece of the business, I'll guarantee you to help transition and have all these fund managers use the platform after building. So yeah, we did that. So that's one of the things that I did in addition to helping them get the regulatory approval. So we went to each, I guarantee that we went to each of these regulators that we worked with to just make sure the transition is done right. If you're going to maintain the licenses, are they going to be under the new entity or under the So I did, that's one of the guarantees that I gave them, and I will support for the next sort of 3 years.
I would say discount rate and cash. So how do you increase the upside of that multiple? And then on the other hand, how do you reduce risk, which would reduce your discount rate, which would make everything a lot more profitable for the long term, for the valuation.
Great. Thank you so much for being on the panel today. I guess this is the last panel of the day. I don't know who's doing the closing.
Thank you very much.